We're looking at the outlook for various sectors of our economy, and unfortunately, if you own a home or a property, house prices are expected to remain stagnant this year. FNB has released figures for last year that show that growth in home prices continued to slow. The FNB House Price Index rose by 5% for 2016, slower than 6.5% for 2015. Now, if you consider that inflation was higher than 5% last year, in real terms, the price of your house probably fell by more than 8%. Well, to discuss property, all things property, we're joined by FNB's John Lewis. Great to have you with us,
Francis.
John. So let's look at this year. You say that house prices could go up by 3% thereabouts, but again, that'll be lower than inflation. So you're going to lose, basically.
That's right. What if we look at the annual average price growth for the last few years, it's sort of the best year post the recession of 2008 was 2014, 7.2%, and then it slacked off 6.5% in 2015, 5% last year, and we still expect it to go lower on average for this year before turning the corner mildly in 2018. The reason for this is it's very much a lagged response to about 4 years of broad economic growth slowed down to near zero last year. That puts pressure on employment and on personal disposable income growth. And then, of course, we had 2 years of mild interest rate hiking, also just taking something off demand for residential properties. So we've got a market that's no longer, a few years ago, agents were complaining about a lack of stock. No longer really the case. There seems to be sufficient stock now.
Is it all just the economy? Are people worried about politics, crime? Are trends changing in how people are buying houses?
I think you know there can be some of that sentiment from the heightened social tensions and heightened political volatility. It is possible that has crept into other certain indices, so it's there. But I think by and large it's a simple economic story, a lack of job creation, a lack of income growth, and a mild interest rate hiking. I think that's it.
A few years ago, it became harder. So if you were a young person trying to enter the property market, and banks pulled back, all of them, including your own, looking at those lending criteria for people who wanted a second property, for example. How strict are the banks being right now? What role is that playing?
Yeah, it's always a difficult one to answer. How long is a piece of string? But, you know, we did pull back around about 2008, quite dramatically from where the banks were before that in the boom times, but have relaxed somewhat. We're somewhere in between 2008's pullback and the lending at the height of the boom. We have become more relaxed since 2008, but no, I mean, you know, the amount of lending that's being done now is still a lot less than what it was in 2007, 2006, and I think with good reason. You know, the household debt to disposable income ratio rose sharply up until 2008 to 78%. That's very high for us. 88%. That's very high for a low-income country like South Africa. So the high levels of debt then, you just couldn't realistically carry on lending at that pace. And what's happened now is, as a result of tighter lending, is a very positive development in terms of a decline in that debt to disposable income ratio to 74% from 88. That's great. It's slowly but surely making the household sector less vulnerable, but it's still a high number, and I think, you know, at least we need to go below 70%.
You were doing this earlier, but can you put it in context a bit more? So 2007, property is booming, and we reached this peak. Then the recession happened. Just explain what's happened to the property market since that.
Well, there was a modest recovery there afterwards. It wasn't, well, not a modest recovery. It was back to a very well-balanced market around about 2014 with some price growth in real terms, which means that, you know, it was very well balanced between demand and supply. But nothing boom-wise. You know, the household sector was just too indebted. And your economy hasn't really shot the lights out ever since. You know, it also recovered somewhat, But we're talking these days growth rates, well, at the height of the post-recession recovery, I think we reached about 3.5% GDP growth. That's still well off the 5% plus that we saw back in the boom times. So we've never reached that again economically, and by and large, the housing market stayed in single-digit growth territory since the end of the boom times in 2008, bar the Western Cape. That's had some big structural changes. Perceptions to that province have really improved. They've done a lot of good stuff there, attracting affluent sort of migrant repeat buyers. And that economy and that property market has done something different. So last year they were still in double-digit growth figures.
Oh, that's very interesting. Yeah. And I guess still certain areas, probably in Gauteng, depending where you work, is it still based on location?
It's still based on location. I think a lot of these northern suburbs areas have done fairly well, around the major business nodes. But I think everything has been slowing in Gauteng at the moment. Gauteng has, although it's got a higher per capita income than the Western Cape, it's got much more land availability. Look, that is changing. I mean, we are building up but it's a landlocked province, so there's always been scope to sort of build out in all directions. Cape Town is somewhat different. You've got the sea on two sides and a mountain in the middle, and it's a lot more land constrained. So that has also, the supply side constraints there have also helped property.
Okay, so you were saying things looking better 2014. We're now back in negative growth. Last year, you're expecting that this year as well. Could that outlook change? I don't know what you think of the ANC's prediction, maybe very optimistic 2.9% growth, but if the drought breaks, could things start looking a bit better? Yeah,
forecasting is a hazardous business. We're at about 1% we expect for this year. We do expect a slightly better economy. Last year was nearer to zero. And that would be the result of some drought alleviation, boosting agriculture a bit. But agriculture is quite a small sector, so that doesn't make too much of a difference. The bigger difference would possibly be from better commodity prices and a mining sector improvement and some parts of manufacturing. So it's improvement we do expect. We're not in that 2.9% thinking. We're more nearer to 1%. But and ultimately, that and if that were to carry on into 2018 and improve some more, then ultimately the property market would turn. And I think later in this year you could see a slight improvement in the property market. But going into when we look at our monthly year-on-year house price growth, it was down to 1.6 by December. So house price growth is going into the year very low. And so our 3% actually does represent some improvement later in the year. That would be better. We would start off with perhaps 1% in January if we're lucky, and hover around that for some time. And as the economy starts to turn, you might see some mild uptick in house price growth too later in the year, and that would take the average up. But for the year as a whole, we're still talking lower average price growth than last year.
Okay, so in finality, if you're a homeowner, this is not the time to sell. It's a buyer's market.
It's becoming more and more a buyer's market at the moment. We've seen average times on the market lengthening, and it's tougher to sell. So, that's...
And for buyers, does that mean there are bargains out there?
Coming, I think, more so. There's not a lot of financial stress in the market at the moment. Contrary to some reports, we're not experiencing major, high levels of non-performing loans. It's all a fairly good story. So there shouldn't be a lot of distressed selling, and that's where often the real buying bargains are. But no, as the market goes through this weak patch, you would get some bargains more so than 2 years ago.
All right, thank you for your analysis and outlook on the property sector. That was John Lewis from FNB. It was a good day for the local market. The JSE rose by more than 1%, spurred on by resource stocks.